Hello, Nebraska, and welcome to this week's edition of the Retirement Compass, the show dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio, we have two members from Stonebridge Wealth Systems based right here in Nebraska. We have Tim Kulhanek, who is the co-founder, and Jeremy Gove, partner, and you're both retirement income planners. It's always great to be here with you.
Pleasure to be back.
Yes. And I know
Thanks.
you've put together another great show for our viewers at home. If you have ever asked yourself, when should I claim Social Security? How do I know what I'm even eligible for? And most importantly, as a lot of folks are asking today, is Social Security going to be there for me in the future? You're not going to want to miss today's show. We have so much to unpack today. And in our discussion, we wanted to start off with some statistics, which I think are really eye-opening. I think twofold, right? It really sets the context for the conversation, but can also help you at home not feel so alone in these areas. So last year, 2023, the Social Security Administration, there was nearly 70 million beneficiaries who were receiving payments from Social Security that totaled $1.2 trillion. That's trillion with a T. That's a lot of money that's going out every year. But the reality is so many retirees are unprepared for retirement. And I know you shared this stat that the median 401k balance for baby boomers today is only $61,000. So Jeremy, my first question, obviously for a lot of folks, Social Security is really an important piece of their retirement income puzzle. It makes up over 40% of most baby boomers' retirement income.
Yeah, that's exactly right. So one of the things that we find interesting is we talk to people about what is your biggest asset. That's one of the first questions I ask when people come into the office, and most people will say it's their house. Or maybe they own part of a business, or they own a business. That's their biggest asset. And we talk to them a lot about, in Nebraska specifically, if you don't pay your property taxes,
right,
what happens to your house? You lose it. Obviously, it's over a couple of years, but you can lose it. And so the biggest asset that people have, and you don't think of it this way, is your income. And so Social Security obviously is an income that is provided to retirees, and most of the time, that is their biggest asset that they have. But they don't think of it that way. But if you think of, you're going to get a couple $1,000s a month or $3,000 a month for the rest of your life, that number can become very significant. And so drawing Social Security and when to draw, you can leave thousands, tens of thousands, or potentially hundreds of thousands of dollars on the table if you don't do it right.
Right, and a lot of people don't realize that. I used to travel the country and deliver workshops specifically on Social Security. There's so much that goes into it, so many different mathematical calculations. So we're gonna peel back the curtain a little bit, keep it at a high level, because really this is such an individualized decision to help folks optimize what they're entitled to. But if someone's watching and going, okay, I'm new to this, or I'm nearing eligibility age, how does someone know what they're actually eligible for?
Yeah, I think it's important to, like you said, keep it at a pretty high level, 30,000-foot view. Here's the reality. The Social Security program is probably on par with the Internal Revenue Code as far as its complexity. So there's a pretty famous, I'd say, economist from Boston University, Larry Kulhanek, and he will testify before Congress when they have questions on how the program that they wrote actually works, right? He's an expert. And according to Larry Kulhanek, the Social Security Handbook contains roughly 2,728 rules to explain all the provisions within the Social Security Administration's program. And then that's augmented or supplemented by what they call POMS, Program Operating Manual System. And that set of documents contains maybe another 100,000 rules to explain the 2,728 rules.
Right. Not confusing at all, right?
Not at all, right? So it really is, for folks, it's very overwhelming. And so what we do at Stonebridge is we try to simplify things. We say, look, let's just start with some basic definitions. Am I eligible for benefits? And then 2 is, am I entitled? Eligible means you've got the right amount of what we call credits. They used to call them quarters, but now they call them credits. And so I looked this up in 2024. To get 1 credit, you'd have to earn $1,730. It basically boils down to you have to have about 10 years of part-time work, and you're going to be eligible for benefits based off of the requirements there. Number 2 is for retirement benefits, you have to be age 62.
At least, right? Yep.
You have to at least be age 62. Now, we'll get into survivors and spousal benefits and some changes there, or some differences there. But for retirement benefits, you have to be at least age 62. So that's eligible. Number 2, though, is entitled.
Yeah, that's interesting that you've delineated those two. So talk about what that
means. Yes, so to be entitled, you have to actually file the application. So many times people think that, oh, well, I reach a certain age and then the income just shows up. That's not how it works. I actually had a gal in my office one time who was 72 years old. She was still working, and she had not received a dime from Social Security. She paid in for over 45 years, hadn't received a dime. I said, Diane, what's going on here? Why aren't you receiving these benefits that you were eligible for? And she said, well, they just never sent me a check. Social Security will not come calling if you don't file the application to make yourself entitled. The check won't hit the bank.
Right. It's so interesting how unfortunately that can happen, right? But if it's that lack of financial education surrounding this, which is why we're so passionate about making sure you know the ins and outs of Social Security. So the next question obviously is, how does the Social Security Administration calculate one's benefit?
Yeah, so that's a great question, and it is a little bit complicated, as Tim mentioned. It's overly complicated for sure, but what they're determining is they call it your primary insurance amount, PIA, and typically for most people, there's a set age. Well, for everybody, there's a set age based off of when you were born, what year you were born.
Right.
So for a lot of people that we're working with right now, you might be at 66 and 8 months or 66 and 10 months. That's your designated age that you can retire according to Social Security. And so they determine that amount. They use the last 35 years of earnings or the top 35 years of earnings. And so that sounds kind of simple, right? Well, it's not that simple because they take the top 35 years of your earnings, but they take the monthly average of those 35 years, and they also account for inflation. Yeah. So it's like I said, it's overly complicated. The nice thing is at Stonebridge we have software that we can use to calculate that, to help you determine what's the most optimal time to draw, what is your primary insurance amount, and all of that stuff. You can also go to ssa.gov to actually see and print out the statement. They don't mail those statements out anymore. You have to log in and
create your own account, right?
Create your own account, and then you go in and pull it down. But that's basically how they do it. It's a simplified version of it, but they take the top 35 years of your work history and account for inflation in that.
And a common misconception, I know we were talking about this before the show started today, people think, oh, it's my last 35 years. No, it's your highest earning 35 years. It's just for most people. Usually that's happening later in your working career, right?
Typically, but it really depends. I mean, my mom's first full-time job after she got out of college was in Pleasanton, Nebraska, okay? And mom was a school teacher. She's a retired school teacher. And she made $7,000 her first year teaching. It's kind of hard to fathom that in 2024. But the reality is, Social Security doesn't look at that as $7,000. They're going to index that, and so they'll index your average. They call it the AMI, Average Index Monthly Earnings. They index through age 59, and then once you reach age 60, they're simply using the actual earnings the nominal number, if you will. There's no more indexing. But the reality is, this is complex. By looking at your statement, you're not likely to be able to really get this figured out. So what we do at Stonebridge to try to simplify things for you is we're going to run, as part of this written financial income plan that you're going to get by calling in the number at the bottom of the screen, we're going to run a customized Social Security analysis. Not some canned report where it's just like, hey, if you file at this age, you're going to get this much, and if you wait, you get more. We know that. You're educated. You know that. You're watching this show. We're going to show you how you maximize your benefits, and not just for yourself, but if you're married, also for your family. And we'll have more stories coming up in the show with examples of how we've been able to boost benefits tens of thousands of dollars for folks who've gone through the same strategy. So we invite you today to call that number, get that written financial income plan, and part of that, your customized Social Security analysis.
Tim, Jeremy, thank you. I know we've just scratched the tip of the iceberg in this important conversation. We have a lot more to get into, but as Tim was just saying, if you would like to receive your very own complimentary written financial plan from the team of Stonebridge Wealth Systems, again, this is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how they can help and serve you. We know you have questions about your Social Security claiming strategy, about how to build a successful retirement. You can get your questions answered by coming in and taking advantage of this offer. So that number to call is there on the bottom of your screen. Simply dial 866-256-7778. Or if you'd rather not talk to someone right now, but you have your smartphone handy, if you simply pull it out, open up that camera app, you can point, click, and scan that QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to connect with you to schedule your complimentary meeting that way as well. Don't go anywhere. When we come back, we're going to look at some unique situations. What if you were a stay-at-home mom? What if you've been divorced? Are you single? Are you married? How does that impact your Social Security claiming strategy? Stay with us.
You know, if you think about the average American consumer, we don't talk about financial topics very often. And so we spend a lot of time at Stonebridge doing educational seminars and different things that are free of charge. If you're not educated in a topic, how do you make educated decisions? When you're working with a client, you're sitting down with them, they're a little stressed out, but after you go through the process and you really take time to educate them on not only what we're doing for them, but why we're doing it, that really gives them peace of mind, and you can see the weight just kind of drops. And when they leave, I hear all the time,
I really should have done this years ago. But sometimes there's a fear that somebody might try to sell us something. If the things that I can provide, if you don't want, don't need, or can't use those, I've got some good news for you. We're not going to sell them to you. We are fulfilling our fiduciary duty of putting their interests ahead of our own.
Welcome back to the Retirement Compass, brought to you by the team of Stonebridge Wealth Systems, based right here in Nebraska. I'm your host, Kristen Oakley, and joining me in the studio are Tim Kulhanek and Jeremy Gove. We are talking today about your Social Security benefit, and obviously, as we set up in the first segment, so much goes into this conversation. There's so much complexity, and you mentioned, obviously, that some of the strategies, it really does depend on your work history. So what about stay-at-home moms? Because I know that this is a common thing. Usually one spouse maybe works more than another. So talk about that person who maybe doesn't have 35 years of work history to have paid into Social Security.
Yeah. Well, we see this all the time. It's not as maybe common as it once was, but I just was working with a couple here within the last couple of months, and it was interesting. They actually brought 2 of their 3 children into the meeting because they wanted to make sure that their kids were aware of kind of what they were working on and what they were doing. But she stayed home for probably, 15, 20 years because the kids are pretty spread out. There's about a 15-year gap between the oldest and the youngest. And so she stayed home and helped raise the kids and was kind of the head of the household as far as taking care of things on the home front. And he's worked at a manufacturing facility for most of his career. Well, her PIA, as Jeremy was explaining how that's calculated with the 35 years, it's only like about $800, whereas his is about $3,000, substantially higher. And so it's like, well, what about her? Like, does she just get the $800? What if she files early? And the good news is there is something called a spousal boost. So if we want to keep it, again, high level for today. We'll get into the weeds if you want to when you come in for your complimentary written financial plan. But in general, what you got to keep in mind is the lower earner is always going to be entitled to at least half of the higher earner's benefit if they both wait until at least full retirement age. Now, there's a lot of nuances in there. The lower earner isn't going to get any of what we call delayed retirement credits, which we'll talk about a little bit later when you're delaying beyond full retirement age. But in general, in this case, just to keep it simple, if her benefit was $500 and his was $3,000 at full retirement age, well, we just take half of his, okay, so $1,500. She's going to get her $500 plus an extra $1,000 added to her benefit. So she'd be getting $1,500, he'd be getting $3,000 for a total of $4,500 a month. And people are like, wait a minute, no, there's no way that works out, Tim. How is this is just like free money, poof, it just appears. It's how Social Security law is written. And so yes, you're potentially eligible for that. You just have to know whether or not it's a benefit that's available to you, because you have to figure out what your PIA is, which again, we're gonna help determine that. And then 2, you gotta figure out the timing of it. When do I file? Because there are reductions for filing early.
Yes, and I think it's important to presence that, because if someone were to call the Social Security Administration, let's say that you're 62 years old, and you call up and say, hi, am I eligible to take my benefit? What are they gonna say to you? They're gonna say, yes, you're eligible, because technically you are. Now, what you may not realize is that you're gonna be locked into a low lower amount, and that amount's going to stay that low amount for the rest of your life. But if you wait until you reach your full retirement age, or in some cases it might even make sense for someone to wait until age 70, the amount of your benefit's going to increase every year that you wait. So obviously so much goes into this conversation, and especially for married couples thinking about what happens when one spouse passes away. Do you want to talk about that?
Yeah. So, I mean, if we want to just cover kind of the basis, you mentioned you had to be 62 to get started, right?
Right.
And there is a clause that if you were a widow, you can actually draw at 60. But typically, just for the rule of thumb, for our conversations, assume it's 62. And so I actually have a great example. I had a client who was thinking about retiring. He came in. He was 65 at the time. He was wanting to retire at 67, and he just wanted to see if he was on track.
Right.
And so I met with him over the course of several weeks, and as we met more and more, he started to express more and more frustrations with his job. And so, but as we were looking at Social Security, when we were talking, he told me that he has a 14-year-old daughter at home, which that doesn't happen all the time,
Sure.
right? And so I started doing a little bit more research, and she was actually entitled to Social Security. And then because she was entitled, now his wife, who was 60 at the time, was also entitled to draw Social Security. And so it absolutely made sense for him to go ahead and stop working at 65, start drawing Social Security now, because his daughter actually was able to draw Social Security through age 18.
Wow.
Now his wife had Social Security up until her daughter was 16, but then at that point she was 62, and so she could actually start drawing half, well, it wouldn't be quite half, but half of his benefit.
Right.
And so there's just a lot of creativity that you can use, and every situation is unique. That's why we have to do the analysis. That's why we have to dig into the numbers.
Right.
So
we can't do blanket statements on the show with this stuff, because it really does depend. There's so many nuances and so many rules that apply to each individual situation.
Yeah, absolutely.
Yeah. Well, and also you have to think about, what if one spouse passes away first? So talk about that. Let's say older in life, right? Because you're going to lose one of those Social Security checks.
Yeah. So this is a kind of a great example. So let's just use, we have couple A and couple B. And Kristen, you can tell me which couple you would rather be.
Okay.
Okay, so we have, just all things being equal, we have $500,000 in our retirement account. Okay. And so we have couple A who's getting $1,500. So the wife gets $1,500 from Social Security. The husband gets $1,500 from Social Security.
Okay.
Okay, so they're getting a total of $3,000 a month, right?
Right. Yep.
So that's couple A.
Okay.
Couple B, same thing. We have $500,000 in savings. It doesn't really matter which spouse. You could say the wife's getting $2,000 a month, and the husband's getting $1,000 a month.
Okay.
So they're getting $3,000 a month from Social Security. Which couple would you rather be?
Trick question, right? I would rather be couple B, because I know that when a spouse passes away, you're going to lose one of the Social Security checks, but you get to keep the higher of the two. So in that example, as you said, couple B is going to win in that sense.
Absolutely. So yeah, you definitely want to be couple B. And that can have a big impact if you lose a spouse early in life, and you live, 10 or 20 years beyond what your spouse did. If for couple A, they're going to get $1,500 a month, and couple B is going to get $2,000 a month.
Right. Yeah.
So yeah,
the
it's
one
a significant
person who's
difference.
left. I think this also speaks to why it's important to figure out when to claim, because none of these decisions can be made in isolation. I think sometimes folks unknowingly think, oh, I'm eligible, I should just go ahead and claim, not realizing that they are getting that lower amount, and that could negatively affect their spouse should they pass away first.
Not only that, so my father, so I've been in the financial services field since about 2009, 2010. And it was shortly before that my dad was retiring. And he decided to draw Social Security before he retired, and he decided to draw it at like age 64. And his full retirement age, he's a 46 model, so his full retirement age.
46, he was born in 1946.
That's just how my family, I'm an 86 model, he's a 46 model, right? So anyways, he was still working, and so he was subject to what's called the annual earnings test. okay, which I've got it written down, but basically it's about $23,000 in 2024
Right.
that you can't earn more than that amount. And if you do, Social Security is going to sock it to you, because for every $2 over that amount you earn, they're going to withhold $1 in benefits.
Yes.
So not only are you permanently lowering your long-term benefit for you and your spouse, but you're also temporarily lowering the benefit you're getting today. Now, again, I get it. People are like, oh, I want to get my hands on this money while I can.
Right.
But you know, it's kind of one of the, I guess, rules of the financial services, of your financial life, not just the financial services industry. And Warren Buffett has said this before, that when he talks about the stock market, he says, the stock market is an efficient tool for transferring wealth from the impatient to the patient. Well, we got to make sure that when we're planning for things like Social Security, yeah, we want to get that money, but we have to be patient, not make foolish decisions that are going to end up costing us, and more importantly, costing our family long term.
For sure. Well, and it's called givebacks, right? And that's what a lot of people don't realize. What the government giveth, the government loveth to taketh away, I used to always say, right? But that's such an unfortunate consequence when folks don't know all the rules. You go ahead and claim because you're eligible, but you're still working, and now you're actually giving more money back to the government.
Yeah, and it's a catch-22 when it comes to things like Social Security and taxes. I mean, yes, you want more money. At the same time, the more money you accumulate in things like tax-deferred accounts, all of a sudden that's going to create more taxable Social Security, which I don't know if our audience knows this or not, but Social Security originally was not supposed to be taxable, and that gripes a lot of people. They're like, hey, wait a minute, I paid into this. I paid taxes on that money when it went in. That's true, you did. So part of what we're going to do with this written financial plan process is we're going to not only look at how we maximize your Social Security, let's also minimize the amount of taxes that you pay on that Social Security so that the government isn't taking quite so much away. So what we're going to do is not only that Social Security analysis I talked about at the end of the first segment that we had here today, we're also going to do a tax analysis to try to minimize, turn down the amount of money that the government gets. Because at the end of the day, it's not what you earn, it's what you keep that counts. We're interested in keeping more money in your pocket.
Absolutely. Tim, Jeremy, thank you so much. To our viewers at home, if you would like help making sure that you get to keep more of your hard-earned money, we encourage you to pick up the phone to claim your complimentary written financial plan from Tim and Jeremy and the team of Stonebridge Wealth Systems. Again, that number to call is 866-256-7778, or you're welcome to take out your smartphone, simply scan that QR code, and that will get you connected as well. More on today's conversation regarding your Social Security benefits right after this.
As Americans, we strive for better, from a better house to a better career to a better life for our children and grandchildren. Better has become the American way. But when it comes to your retirement, what does better mean to you? More income, a flexible lifestyle, better solutions? Yet a better retirement begins with a better financial plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity to plan for better.
Welcome back to the Retirement Compass, brought to you by the team of Stonebridge Wealth Systems. I'm your host, Kristen Oakley, here with Tim Kulhanek and Jeremy Gove. We are talking today about making sure that you are optimizing your Social Security benefits. And obviously, as we've talked about already on today's show, so much goes into this. We have to keep it at a high level, but it is a very individualized, personalized thing. I want to touch on people who are divorced, because I think there's a lot of confusion around divorced Social Security benefits. So can you touch on that?
Yeah, sure. So really, the government has two different categories when it comes to divorced spouses, because we talked about the stay-at-home mom earlier. What happens if years later there's a divorce and now she no longer gets that spousal boost? What do we do? Because they're no longer married. And the government has created some rules that kind of outline that. In general, you have to think about this. You have to the marriage had to last for at least 10 years to be able to draw on a former spouse. There's something called deemed filing, which means if you file early, let's say you had earnings on your own work record and you file at like 63, for example, the government's going to pay you everything you're entitled to, because deemed filing means you can't just say, hey, I only want to get my spouse's benefit, I'll switch to my own later. If you're not full retirement age, that's not going to work. And the government's changed the rules on that anyway through the 2015.
Yeah, there used to be a whole bunch of strategies out there, but to your point, those went away in 2015.
Bipartisan Budget Act axed a lot of that. But in general, let's just assume both spouses are at least age 62 and the marriage lasts at least 10 years. You'd be able to file, even if you didn't have any work history of your own, you were not eligible for a benefit based off of those credits, you could still file because that marriage lasted 10 years and get a benefit based off the former spouse. Now, I counsel folks on this all the time. And I was visiting with the gal one time and explained to her how this worked. And this was actually before the 2015 Act kicked in.
Right.
And so she was actually able to use some of those old strategies, which
Yeah.
are really cool.
Right.
And I explained how it worked. I'm like, here's what we're going to do. You're going to file off him first, and we'll switch to your own later on. Because then it worked. And she just kind of sat there and she goes, is he going to find out? You know, worried about, like, is there going to be some sort of,
It's
you know.
a common real concern for folks.
And the
yeah.
answer is no. Government's not going to call them up, and it doesn't affect their benefit at all.
Right, that's what's
They still
crazy
get the same
is you
amount.
can be collecting off of an ex-spouse if you're eligible to do so, and they will never know. They will have no idea.
Correct.
Right.
Yeah, it's wild. No wonder that, you know, the Social Security Administration is paying out $1.2 trillion just last year alone,
Well,
right?
let me give you one example of that. So Johnny Carson, a Nebraskan. Did you know he's a Nebraskan?
I did not know
yeah,
that.
Norfolk, Nebraska.
Yeah,
Proud of
yeah.
Johnny. So, so Johnny Carson, he was married several different times. I think 4 times to 3 different women. So married the same one twice, something like that.
Right.
All of those marriages lasted long enough that at one point in time, all 3 of those women were drawing off of his work record.
Oh my goodness.
Plus he was.
Right.
So he was getting Social Security, his full benefit, and 3 other women were getting half of his benefit. So back to that 1.2 trillion, there you go.
Right? It adds up quickly for
Yeah,
sure.
yeah.
Well, and I think this speaks to why a lot of folks are concerned with the question of, is Social Security going to be there for me? So Jeremy, what would you say to someone who's watching and going, gosh, I've heard it's supposed to run out of money. What do I do about that?
Well, it's interesting. So there's a lot of discussions about that, and it's hard to know what to believe for sure. I mean,
sure, yeah.
today they are collecting more than what they're paying out, barely, but they are collecting more than what they're paying out. And so I think what we counsel our people to do is let's figure out what makes the most sense for your situation, and let's go with that. We'll adjust it. You know, the plan. If Social Security starts to be reduced, then that's something that we're going to account for. In our financial planning that we do, we're already accounting for that anyway. We actually we assume that Social Security is going to be reduced by 20%. And we will allocate that and say, well, how would this affect you? And, you know, so we're already doing that. But I think to make decisions based off of fear, a lot of times that they don't go the right way for you. I have a client, they, you know, in Tim's example, so their income was over $350,000 a year. Their CPA told them to start drawing Social Security at 62 because we don't know how long it's going to be. And these clients are 74 now. And so they've missed out on a lot of their Social Security benefits.
Right.
And it'll affect their income down the road because they're retiring and stuff. And so the bottom line is we don't make decisions out of fear.
Right.
We do a lot of planning so we don't have to make those decisions out of fear. And so if you're sitting at home wondering what should you do, we've thrown a lot of different things at you in this episode. And so what I would encourage you to do is just call the number, give us a call, sit down with us, sit down with our team, and we'll walk you through the strategy that will make the most sense for your situation. And that's the best advice I can give anyone.
Absolutely. Jeremy, Tim, it's always a joy to be with you. Thank you
Pleasure.
so much for all this valuable information. And the reality is, again, if you call the Social Security Administration, they can give you information, but they cannot give you advice based on your individual personal situation. The only way you can get that kind of advice is by coming in and meeting with someone like the team of Stonebridge Wealth Systems. They're here to help you. 866-256-7778. We love you, Nebraska. We'll see you next week.